This is a short revision video on the usage of the monetary policy. Woohoo! It is part of the national economy section of economics AS level with AQA. Sorry, I sounded really excited there. I get quite enthusiastic about these policies because they're just so cool how they work and stuff. Okay, monetary policy, that's controlling the economy via changes in monetary variables, such as the monetary supply, so that's quantitative easing, and interest rates. We don't do too much on quantitative easing in this. I don't know if we even mention it after this, but it's basically when the government, gives the banks money and it wants it to let the banks loan it out to lots of people, so people have more money, so aggregate demand rises. So basically, if we ever talk about interest rates having the effect of causing aggregate demand to rise, it's the same if we're doing quantitative easing, but that doesn't really come up much at AS level, so it's just something nice for you to know. And then central bank. The central bank is the financial institution in a country or group of countries responsible for issuing notes and coins and setting short-term interest rates. In the UK, I believe that the Monetary Policy Committee is in charge of setting interest rates. That can be shortened to the MPC, and their main target is to keep inflation proper low. So it wants to retain inflation about 2%. It's actually doing a bit better than that at the moment. We're at 1.7%, I believe. If they don't manage to meet the target for inflation, they have to write a letter to someone. I think it's the Prime Minister or the Chancellor of the Exchequer or something like that, and they have to write a letter apologising and explaining why they didn't manage to get inflation to that level. Interest rates, woo! Now the interest is the cost of borrowing and the reward for saving. That's the definition that people use. I mean, I absolutely hate it as a definition, I'm sure you'll hate it too, but it's just impossible to think of a decent definition for interest rate. So that's the one that people typically use, even though it's horrible. You've got a massive variety of interest rates out there, particularly the massive difference between interest rates from banks when they're loaning people money and when the banks are actually looking after money for people, or I suppose they invest it themselves, don't they? The reason for the difference is because the banks need to make their money, so they make their money when people borrow money, so they have massive interest in that. When people take a loan out, you have to pay back a much greater amount than if you leave your money in the bank. The bank gives you much less back. Also, this reason for the high rate of interest when people are being loaned money is to cover the risk that people won't pay it back. Interest rates also tend to move together, so say one bank interest rate changes, lots and lots of banks' interest rates will also move back in the same direction, so you won't have a bank that's got a 2% interest rate and a bank with like a 10% interest rate on a sort of account with the same benefits and perks and stuff, because that's just not how the bank system works. The next thing is just so important to know. Interest rates and aggregate demand have an inverse relationship, so when interest rates go up, aggregate demand goes down. This is because consumption falls. If interest rates rise, people put their money in the banks, they save it rather than spending. If they don't spend it, they're not consuming as much, so consumption falls. And obviously consumption is a component of aggregate demand. If interest rates fall, they're low, people think there's no point in saving my money because I'm hardly going to get anything back, I may as well go out and spend it, and they go and spend their money. This causes aggregate demand to rise because obviously they spend it on goods and services, and that increases consumption. Also, when interest rates are low, firms are more likely to borrow money to invest into their company, and this means that they invest, and obviously investment is a component of aggregate demand, so that's another connection between the two. Interest rates and exchange rates are also interlinked, so if the interest rate rises, should we say, if it rises, people from other countries think, oh, I might put my money in this country, I'll get more money back. So they sell their old currency and buy the pound. If they buy the pound, they're demanding the pound. Increasing demand pushes the price up, so the price of the pound rises. Stronger pound, which means a stronger exchange rate. This isn't good, obviously, in terms of aggregate demand, because a stronger exchange rate means that our exports to other countries seem more expensive, so they don't buy them, and imports seem really cheap to us, so we buy lots and lots of imports. So essentially, if we have a high interest rate, it causes aggregate demand to fall further because we will import more and export less. And obviously the opposite occurs if we do the opposite thing with interest rates. So if we put interest rates down, we'll get a weak pound, which will have a right shift effect on aggregate demand. The real interest rate is the rate of interest take away the rate of inflation, because obviously it's great if you can put your money in a bank and you'll get a 6% return interest rate wise, but if the inflation rate is 7%, you're actually making a loss. I mean, obviously the real value of your money has fallen. I mean, your money can't buy as much because of inflation. It means that prices have risen higher than the value of your money. So although you might be getting more money back from the bank, the actual amount that you can buy with this money is less than it was at the start of the time when you put your money in the bank, if that makes any sense. We now get to return to these beautiful aggregate demand and aggregate supply models. I've decided to use a Keynesian curve because I think it's much better for showing inflation and stuff on it. So if we look at the one on the left, that is an increase in interest rate for all the reasons we discussed previously. An increase in interest rate causes there to be a decrease in aggregate demand. I mean, it says inflation at the top there. Often that's because if there is inflation, the MPC will put up interest rates. I mean, you don't have to have inflation for interest rates to rise, but I mean, chances are there will be if interest rates are being pushed up. It's to combat inflation. So we've had a reduction of AD from AD1 to AD2. This is a fall in price, but we haven't actually lost that much output. So it's basically a reduction in inflationary pressure. Because if you look there, the price level has fallen quite a lot, but the amount of output really hasn't changed. So we've basically just lowered the prices by reducing demand. On the other hand, if we're looking at the reduction in interest rate, if we've got a low level of output and then the interest rate falls, we'll see an increase in aggregate demand from AD to AD2 for all the reasons we've previously discussed, and that will cause there to be a rise in real output because we'll be moving along the aggregate supply curve. It will be an extension of the AS curve. I mean, there's a small rise in price, so slightly inflationary, but we're getting a massive increase in output, and you would expect there to be a rise in price because maybe you're thinking of new products, new goods and services. It's expected for there to be a rise in price over time, hence we set a target of inflation of 2% rather than 0%. It also allows for prices to fluctuate slightly as well, which is necessary in a rapidly changing economy. We're now going to look at the transmission mechanism of monetary policy. Sounds really horrible and complicated. It's actually quite simple. It's essentially the influence of changes in the interest rate on the components of aggregate demand. And we've looked at a few of these before, but we're going to look at these again really quickly now. I'm sorry, I just need to interrupt this quickly. Doesn't that look so beautiful? It's like a pretty rainbow. I mean, I'm missing yellow and that colour that no one knows about. It doesn't really exist. I think it's not indigo, it's the one before indigo. Which of you gave battle indigo? Yeah, it is indigo. Indigo's missing, but you know, I just couldn't find it on my computer, so. And there are also only 5 components of aggregate demand and 7 colours of the rainbow, which is slightly problematic. But anyway, there is your list of the different components of aggregate demand, and now we're going to talk about the effect of a rise in interest rates on all of these. Consumption. Interest rates rise, savings more profitable, people save rather than spend, and consumption falls. Interest rates rise, borrowing's more expensive, people just don't borrow, they can't afford to borrow, so maybe they won't buy them a birthday present because they can't afford to borrow money, so consumption falls. Interest rates rise, people have to pay more on mortgage payments, only if they've got a variable rate one, not the fixed ones, and I think it's quite advisable to take out a fixed payment rather than a variable one, because otherwise you could end up paying a ridiculous amount. But anyway, those people who have got variable rate mortgage payments have to pay more, and that reduces their disposable income, and thus they consume less, so reduce consumption. Government spending. A rise in interest rates or even a fall in interest rates has no major effect on government spending, at least nothing you need to be worried about at AS level. Investment. Bum bum bum. Interest rates rise, businesses save for future investing. It's more profitable for them to save. I mean, they get money when they, save in the bank, they'll get quite a bit of money in interest rates. And they can't afford to take loans out as well to invest, so they can't afford to do that, so they don't do it. So the bank will offer them a loan, but it'll be at a high interest rate which they don't want to pay back, so they'll say no, I'll wait for the interest rate to fall. So that'll be a reduction in investment there. Also, when the interest rates rise, consumption falls for the reasons we saw above, and that means there's a reduction in a firm's confidence, which means a reduction in investment. Also, we're about to go on to exports and imports. We actually have a reduction in the amount of exports when the interest rates rise, and that will also reduce the firm's confidence because they'll think we've got no international markets, they won't invest. Finally, exports and imports. I mean, we did this a few minutes ago, I'm just going to go through it really quickly again. The interest rate in the UK increases, bank deposits in the UK become more attractive, people with deposits abroad move money to the UK, they sell the original currency, they buy the new currency, there's an increase in demand for the new currency, so the price of the new currency rises. UK exports are more expensive abroad, so we export less, and UK imports seem cheaper to us, so we import more. So therefore, there is an increased current account deficit. So basically, we're importing more and we're exporting less. I've got a table with all of this written out on all the different 5 components. If you want me to email it to you along with the whole set of notes if you want, I can email that to you, because I just couldn't type it all out onto the PowerPoint. It simply wasn't going to fit, and if I did fit you wouldn't be able to see it. I mean, you can hardly see stuff as it is, so I was like, I'll just have to leave it. But essentially what we've just shown is that an increase in interest rate leads to a fall in aggregate demand. If we did the opposite, so if we closed interest rates down, we made them lower even. I don't know why I said they closed them down. Pretty sure that's not possible. If you made them lower, you'd have the opposite effect, and therefore you'd get a right shift of aggregate demand. We're just going to quickly look at different ways of measuring inflation. That's the top two, and then the repo rate as well. The RPIX basically is a measure of price level. It excludes payments to service mortgage interest from the RPI. So if you remember ages ago, we had a video that had all the different 4 factors that government targets and stuff. We talked about all the different ways of measuring inflation. We did RPI. The RPIX is basically the same, but it excludes the payments to service mortgage interest. Then we have the CPI, we've talked about this one before. It's a measure of price level, but it excludes all housing related costs. I mean, this is the one we use to compare ourselves to the rest of the Eurozone and the Europe and the EU and stuff. But it's quite inaccurate in terms of the UK in measuring price level and stuff, because housing is just such a major part of many UK homeowners' spending, and pretty much everyone in the UK. I mean, we're a nation of homeowners. We rent, we let, we have flats, we have houses, we've got whatever we've just got so much housing stuff going on here. Repo rate. That's the interest that's set by the Monetary Policy Committee to influence inflation. So it's basically, the interest rate. It's like the one that's there, and then all the other banks aspire to it. Well, they use it as their base rate. So basically, it tells the banks roughly where they need to be, and then the banks will change it according to what they see fit. The current UK target for inflation is 2%. If inflation is above this, the MPC will think, oh no, this is terrible, we need to reduce aggregate demand. Therefore, they will increase interest rates. And if inflation is below 2%, the Monetary Policy Committee will think, oh no, we need to increase aggregate demand, and therefore they will cut interest rates. Obviously, at the moment, we have inflation that's below 2%. It's at 1.7% as of this sort of time, and we can't really cut interest rates much lower. They're at 0.5% at the moment, so it's not really getting much lower than that, so we're just leaving it as it is at the moment. As you can see, I got quite sassy with the font there, used that Windows art here. Time lags. This is basically a major problem with monetary policy, so if ever you're evaluating it, just comment on the fact that it has 2 years before any changes will really be taken into account. So basically what happens is the MPC has to forecast future inflation and try to work interest rates around this. Obviously it's not necessarily very effective because it can forecast things very wrong. You need really established statisticians to work on it, and even so you can still get things totally wrong. So 2-year time lag's a major issue. Also, something else you want to comment on when you're talking about the usage of monetary policy is when you are raising the interest rate, talk about the effect it will have on the current account, and because it will lead to a deficit essentially, or a worsening of the deficit. So comment on that, because even if your aim is to reduce aggregate demand, having an increased deficit on the current account isn't good for reasons we discussed in the previous video. Money supply. Money supply is the total amount of money in the economy. I don't know when you're ever going to need to use these two terms, but I suppose they might come from multiple choice, so it's just good to know them. Narrow money and broad money. The way I remember it is narrow money, think of notes, stuff you hand between people. That's quite thin, it's flat, so it's narrow. And then banks, people that run banks, they tend to have a lot of money, they tend to be quite fat, no offence, I'm totally stereotyping a typical bank person here. But they're quite fat and broad are quite similar, so that's just the way I learnt it. Anyway, narrow money is basically anything you can physically, pass between people. Notes, coins and bouncers available for normal transactions, so you can access them straight away. If I've got £5 in my pocket, I can give it to you straight away and you can give me a sharpener. If a sharpener was what I really wanted. I've got a sharpener in my hand right now, it's so embarrassing. When I was in year 6 or something, I wrote Miss London on it and I thought it was proper cool. And I don't think I'd even been to London at that point. I don't think I'd ever been to London. I just thought it was proper sassy. Anyway, sorry. Back to broad money now. Broad money is basically money that isn't immediately accessible, so if you can't see it, it's money that's held in banks and building societies. Now we're going to look at the effect of money supply on aggregate demand. I suppose this could be injections into circular income, so that'd increase national income. People would have more, so that'd be greater money supply, I suppose, maybe, possibly. And also quantitative easing. Obviously there's more money supply when we have quantitative easing than we've got reduced quantitative easing. That would be the decrease in money supply. Incidentally, we have our reflationary expansionary, that's when there's an increase in monetary supply, and restrictive is when we hold back the money, so that's when interest rates are high, that's restrictive. Just a few terms might be useful for you. Anyway, an increase in money supply means that people have more, so they can spend more. So that leads to an increase in consumption, which leads to an increase in aggregate demand. So we have a shift of the aggregate demand curve from 81 to 82. This puts pressure on supply and causes an increase in inflation. But we also have a massive rise in output, so it's pretty good. I mean, it leads to increased employment and increased economic growth. And let's not complain about that. Decrease in money supply, not so good. It leads to a decrease in spending power, so people don't have so much money, and a decrease in aggregate demand, so from 81 to 82. Actually, I suppose from 81 to 82, I know why I said it wasn't so good. This is quite good because it's no major change in output, but a massive fall in the price level, so that's just a reduction in inflationary pressure. But if it went any further than that, then it wouldn't be so good because we'd have our fall in output. You know, we'd have a slight fall in price level, but a major fall in output, which really wouldn't be very much fun. I suppose if you were desperate to make a comparison between interest rate and quantitative easing, you could say interest rate has a major effect on the balance payments in the current account, which quantitative easing might not have such a serious effect on it. But with quantitative easing, just because the banks have money doesn't mean they're going to loan it out. So that's, you know, the balance, I suppose, if you want to write arguments for and against. They might be points you want to chuck in. Exchange rates. Woo! I know you've all been really excited for this. Exchange rates is basically the price at which one currency exchanges for another. If it asks you for a definition, which it probably won't because it did quite a while ago, you could say, you know, it's the value of one currency in terms of another, the price at which one currency exchanges for another. Probably give an example, so like pounds in terms of euros, stuff like that. You might want to write about strong and weak. Don't go into too much detail, don't be too keen. Like, I used to write half a page for my definitions. I mean, I've got time because I'm quite a fast writer, but it was really unnecessary and quite stupid. And then we have hot money, which is money liable to rapid transfer from one country to another. It's usually attracted into the UK by high interest rates. So people think, ooh, let's attract money to the UK by raising our interest rate. Actually, no one thinks that. But anyway, people in other countries see the high interest rate, they think, oh, I want to save money here, so they move their money, they put it here. So there's an increase in demand for the pound, and we have a stronger exchange rate. We're now going to look at the advantages of a strong pound. Woohoo! I mean, they're in green, because they're supposedly a good thing. So if you didn't pick up my green and my reds, that's why they're there. Green, cheaper imports. If we have a strong pound, imports seem quite cheap to us. So I suppose we have a rise in the real living standard of consumers. I mean, it's not good for the balance trade deficit, but we still get cheaper imports, so people in the UK can afford to have more goods and services. They can have a more luxurious lifestyle if that's what they're really craving. Also, if we're importing raw materials, moving on to the second point here, if we're importing raw materials, they're actually cheaper for us. So this reduces our production costs for firms, which means that there is a right shift of the short and aggregate supply curve. It enables more firms to enter the market. We can also import new technology, which encourages firms to actually invest in new technology. So say China is selling us some new technology and we've got a strong exchange rate in comparison to China, you know, strong exchange rate of China, so it seems cheap to us to import this new technology. We can import it and it will raise our productivity, lower average cost, or we'll be able to sell more, stuff like that. And I suppose eventually, if we've increased our productivity, we will have a increased long-run aggregate supply, increased capacity to supply goods and services, which is always a good thing. And finally, lower inflation. Because we have these cheap imports, domestic suppliers have to face competition, so they try really hard to reduce their costs and prices. So UK firms also lower their prices to try to compete. I mean, it's quite hard to compete with cheap imports, but they will try their hardest. So prices within the UK will fall, so it's actually slightly, it's a reduction of inflationary pressures, essentially, I'd say. Now moving on to the costs of a strong pound. It's sold in red, and red's for danger, and red's for sass. I don't even know if red is for sass. I think red's quite a sassy colour. Anyway, we're looking at the costs of a strong pound now. Reduced business confidence. Sad, sad, sad. If there is a reduction in demand for our exports, because our exports seem quite expensive to people in other countries, we've got a reduction of, ability for the firms in the UK to supply goods and services, so there's going to be a fall in confidence for them, because they're going to think, we've got nobody to sell anything to, so they're going to be less confident and less likely to invest, which means they're going to have less capacity to produce in the future in comparison to countries who have had firms that have invested loads. Then we have an increase in trade deficit, sadly. Obviously, if our exports are expensive and our imports are cheap, we're going to be exporting less and importing more. So that is a current account deficit. Not so good. lots and lots and lots of problems with that. Increased unemployment. If exports are expensive abroad, if our exports are expensive abroad and other countries can produce cheaper, eventually we're going to have no market for our exports whatsoever, so those industries are going to have to shut down in the UK. Deindustrialisation, loss of industry to countries abroad. This leads to major structural unemployment. And finally, slower economic growth. If we have a fall in exports and a fall in aggregate demand, because obviously exports are part of the aggregate demand, they're one of the components, that is a reduction, essentially. It's going to lead to a reduction in our rate of economic growth because of the left shift of the aggregate demand curve. And obviously this leads to a fall in employment, which is never good. We've got a fall in output, essentially leads to a fall in living standards as well, because unemployment, for reasons discussed in a previous revision video, probably the one labelled employment and unemployment maybe, has many costs, both socially and personally, and also economically, in terms of the economic ability of a country to produce. Because obviously if we're not using people, we've got loads of labour resources wasted, that's irrecoverable. We're never going to be able to get that lost output, potential output I suppose, back. And on that horrible, tragic note, this economics video meets its close. Hopefully you've had fun learning about the monetary policy. Next time we're going to be doing the fiscal policy, which is, if anything, even more exciting. So I guess I'll see you then. Hope this video has helped you. Have a lovely day and best of luck in the exams that are coming up way too soon. Have a lovely day. Bye.